Hello, everyone, and welcome back to Airdomo Global. I'm Stephanie, co-founder of Airdomo. And look, we get a version of the same question every single week, maybe every single day, right? A buyer falls in love with a home in Portugal or Costa Rica or Italy, and then someone over coffee tells them something scary about American taxes, and the whole project stalls, and you screw up my deal. No, I'm just teasing, but they do. They get all freaked out. And so today, we're doing an entire episode that is a clear, plain English walkthrough of what owning a property abroad actually means for an American buyer from a tax and reporting perspective. Now, one important note before we start. Charles and I, we're not CPAs. We're not tax attorneys, okay? Nothing in this episode is tax advice for your specific situation. What we are going to do is give you the map, so that when you sit down with your advisor, you're asking the right questions. So, Charles, can you set us up on this?
Yeah, absolutely. So the headline, I think, that sometimes isn't fully recognized by the buyers, and it's a big one, is that the United States taxes its citizens on worldwide income, no matter where you live or where the assets are. So that's like, and very few other countries do that. In fact, I think only a couple really do that. So it's an unusual setup, but it's one that you have to have top of mind when you step into this game. And it doesn't mean that buying property or owning property is a bad idea or a tricky deal. It just means that the rules are different for what you're used to, perhaps domestically, and there's a risk to not understanding them top to bottom. So today we're going to go over 5 things, which is why this U.S. The citizenship and tax piece matters, the reporting rules, how to think about ownership structure, the countries where the tax treaties are the friendliest, and how to build the right advisory team to get the best results. So let's start out with, what is you mentioned this, the shock and surprise that sometimes accompanies this process, Stephanie. Like, what do you run into most with buyers that is an eye opener that they talk about?
Honestly, it's that the IRS doesn't stop caring about you when you cross a border, okay? Most buyers assume that once they own a home in Italy or Mexico, that the tax conversation is just an Italian or a Mexican conversation. It is not, you all, okay? Here's the basic framework every American buyer should hold in their head, okay? You will likely owe taxes in 2 countries, the country where the property sits and the United States. Tax treaties exist precisely to prevent you from being taxed twice on the same income, okay? Does that make sense? Tax treaties exist precisely to prevent you from being taxed twice on the same income, but they only work if you file correctly. Okay. Foreign property itself is not reported to the IRS, but the bank accounts you use to buy and maintain the property almost certainly are. Okay. So rental income from a foreign property is fully taxable in the US, even if you never bring the money home. It's because you are, in fact, a US citizen. And when you eventually sell, the capital gain is reported to the US with the foreign tax you paid credited against your US bill.
And there's a timing piece to it too, right? Everything has to line up. So if your foreign tax credits, they can offset the U.S. taxes, but if the years don't line up or the reporting period doesn't line up, that's where it gets to be a problem. So a cross-border CPA really can earn their fee for you. They'll help you keep those credits from getting stranded and not used. You want to make sure you use every piece of it you can get. And let's talk about the acronyms that kind of send shivers down everybody's spine and puts you into a cold sweat. The FBAR and the FATCA, FATCA. What are those really?
Those are both reporting requirements. They're not taxes, okay? That's the most important thing to understand. Filing them cost you nothing in tax, but failure to file them can cost you a fortune in penalties, okay? So the FBAR, which is the FinCEN Form 114, if the combined balance of all your foreign financial accounts exceeds $10,000 at any point in the year, you must file it. This is the one most buyers trip on because that threshold is per aggregate, not per account, okay? And then the FATCA, that's IRS Form 8938. It's broader and filed with your tax return. Thresholds are higher. FBAR and depend on whether you live in the US or abroad and your filing status, okay? Foreign real estate held in your own name is not itself reportable on either form, but the account you wired money through and any entity you own that holds the property almost certainly is. Foreign rental income gets reported on Schedule E, just like a U.S. rental, with the foreign tax credited, calculated separately. And if you hold a property in a foreign company or trust, the reporting can expand significantly. This is where structure choices have real reporting consequences. And Charles, you said it, this is where you must have a CPA that understands foreign investments, because when you have, and we have those relationships, when you have a CPA that understands that, they verify and make sure that you don't get taxed twice for the same income. That is their job.
And those penalties can be pretty mind-boggling. So you got to be careful. And the penalties on FBAR for one misfiling can be more than the account balance itself. So if nothing else, remember that there's the $10,000 threshold. And then, as you said, with the CPA guidance, with the legal guidance, it's one thing to get somebody who's in country and may have the expertise there, but that's only half the picture, right? If they don't have the clear understanding of how it applies on the U.S. side. So what's the best way to think about the structure for your, for putting that all together?
Well, they're basically three buckets, and the right answer depends on the country and your situation. So personal name is the simplest, cleanest U.S. reporting. It's the lowest cost. It has the fewest moving parts. It's best for primary lifestyle homes in countries that allow direct foreign ownership, okay? A U.S. LLC, sometimes recommended for liability protection, okay? Tax transparent in the US, but some countries don't recognize the LLC structure and tax it as a corporation, which then can create your double tax problem. You don't want to pay double taxes, okay? And then local entity, sometimes required by the country, common in places like Mexico's restricted zones and historically in Croatia, which we talked about Croatia last week. It triggers significant US reporting, okay? And then there's the question of whether to use a fideicomiso, a corporation, or hold it in your name within a trust. Look, these are all country specific, and the right answer in Mexico is not the right answer in Italy. And so that's why it's so important to utilize IRDOMA. Again, this is one of the biggest reasons why Charles and I brought this company to life, was so that all of these things weren't guesses. We could arrange these things for you.
Yeah, and there are, without making people afraid to jump in the process, because there is a way to do it that's safe, that's secure, that gets you through with a great result. But there are mistakes out there that are easy to make if you don't follow the playbook. So, for example, setting up a structure to save on a local inheritance tax, which is great, and you should leverage it where you can, but with doing that without realizing that you might have created a U.S. reporting burden that costs thousands of years, inadvertently doing that. So the structure has to work on both sides. You have to get a good team and a good framework to help you understand that. But there are places where this happens more smoothly than others, right? So where does this work the most cleanly? Walk us through the places in the world that are particularly friendly for American buyers.
Well, some have very strong tax treaties with the U.S., and some have favorable local rates, and some then have specific incentive regimes for new residents. Portugal, the famous non-habitable resident regime, that was closed in 2024, but a successor program is available for qualifying professionals. And so strong U.S.-Portugal tax treaty, capital gains on primary home can be exempt if reinvested in an EU primary home. So if you go there, you buy a home, you go to sell it, it's exempt if you turn around and reinvest it in the European Union. Okay. Italy has the 7% flat tax on foreign income for retirees who relocate to qualifying southern towns, and that is still in effect. And then Greece has the flat 100,000 euro annual tax on worldwide foreign income for new high net worth residents. Okay. You got to be high net worth. Otherwise there is no tax. And then there's standard property taxes that are reasonable. Costa Rica taxes residents only on Costa Rica sourced income. Your US sourced income is not taxed locally at all. property taxes in Costa Rica are famously low. And then Panama, territorial tax system. So there are very strong discounts as it relates to Panama. And a lot of these countries, like Panama, for example, they will have, right now they have going on where if you come into Panama and you invest, let's say $500,000, they will then give you $500,000 worth of tax credits. That's not forever, but they run these short-term or, maybe a couple of years where they decide they want to offer this to U.S. buyers or Canadian buyers or whoever it is that they want coming in, into the country. And so there's a lot of these countries that we have covered in and around all of these different webinars where you will hear us say over and over again, there's no capital gains tax, no capital gains tax, no capital gains tax. So many of them, there's no capital gains tax in these countries. And that means you're not going to get taxed at all in those countries because you're going to be paying it in the US.
Yeah, and it's important to note that tax-friendly doesn't mean tax-free, right?
Right. You still got to pay it somewhere.
You're going to pay somewhere, but tax-friendly means the local side is going to be more favorable. It's going to give you more room to breathe on the U.S. Side. The U.S. filing side won't go away, but it's more manageable when the local taxes are low and the regulatory sort of red tape is low. So that just makes it a lot smoother. But we come to probably one of the most important pieces of this is like, who do you trust to help pull this all together, right? What does your advisor team look like? What is the sort of magic formula for getting that piece right?
You have to have a cross-border CPA, and I don't mean cross-border from state to state. I'm talking cross-border from U.S. to another country, someone who routinely files U.S. returns for clients with foreign assets, and you have to ask that question. You also need lawyers and notaries in the country of purchase. And that is exactly what we do to solve for that, to make sure that we've already vetted those relationships so that you're not on Google trying to find out who is that person for you to trust, okay? And then your U.S. estate planning attorney, because foreign property dramatically changes how your U.S. estate plan works, and existing trusts often don't handle foreign assets the way clients assume. So the fee for getting this team in place is real. It's a few $1,000s, but look, it's tiny compared to the cost of a structure mistake that if you don't set it up at all and you discover it down the road or leave it to your children to figure out later.
Right. And this probably goes without saying, but we'll say it anyway because it happens. But get the team in place before you sign anything, right? Yes. Not after. The structure is so important. Getting it right.
Before you put a deposit on property.
Right. So don't get overexcited. Don't get in front of your skis. Like, get this team going for you. You will not regret it. You'll have a solid, firm structure, and you can breathe easy and sleep at night knowing that you got it right.
That's right. That is right. And, look, to bring it all home, owning property abroad as an American is absolutely workable. I mean, millions of people do it, billions of dollars each and every year is exactly what is happening. And, it's not the same thing as buying a home in Florida, but with a company like Airdomo, this is why we founded it, so that we can make it as simplified as possible for you so that it doesn't take on any more stress than simply buying a home in the US, right? Because we're the people that are here to navigate that for you, okay? And look, the map does look different, but it's understanding that the US worldwide taxation does follow you, and it's understanding the different thresholds that are out there, and then choose your ownership structure with both sides of the border in mind. And leaning toward countries with strong treaties and favorable local tax regimes. Again, we do these webinars every single week, and we're talking about these things on purpose because we want you to be aware of those opportunities.
Yeah, absolutely. And it's important to know that at Airdomo, we're here to help you at every step of the way. We're here to make those connections for you with those vetted professionals so you can build the right team. We don't replace your CPA. We don't replace your lawyer. We just make sure you get the right ones for your situation that's going to get you the absolute best outcome. So we've got a concierge team that vets and sets up the relationship. You're ready to fly with people that can get you to the finish line in a safe and secure way.
That's right. And on airdomo.com, you can browse our active global portfolio listings. You can book a complimentary Airdomo concierge call to start the conversation. we can include some of these structures and have the conversations around that before you ever fly to look at a piece of property. So thanks for joining us. We will see you each and every Wednesday. So until next week.
Bye.